Hey everyone, it's PK here. Today I'm going to talk about whether it's better to buy one expensive property or two relatively cheaper properties. Okay, so there's pros and cons on each side. I know so many people have gone to their mortgage broker and they might have realized that they have $600,000 of borrowing capacity or $800,000 of borrowing capacity or $1 million of borrowing capacity. And it's, quite tempting to just splurge all of that if you have the requisite equity and deposit as well to maximize that borrowing capacity. It's easy just to splurge that on one property. But let's talk about the pros and cons. So if this is a scenario that you're in, then this video will be useful to you. So probably worth listening to the end. So one of the pros of buying one more expensive property is that it's going to significantly reduce your transaction costs. Okay, so when you buy property, there's transaction costs. There's things like legal costs. There's other, non-variable costs, things that just cost an X amount, regardless of how expensive your property is. Bank fees, settlement fees, legal costs, depreciation schedule, cleaning costs for the initial clean before your tenant moves in, a whole bunch of these sorts of costs that are fixed. And of course, if you buy one $800,000 property as opposed to two $400,000 properties, then those fixed costs you'll only incur once. And sometimes those fixed costs can go all the way up to $5,000 or $10,000, right? It all adds up, removalists if your vendor has left furniture there already. So by buying just one more expensive property, that definitely can reduce your transaction costs of those that are fixed in nature. Another pro of buying one more expensive property as opposed to two relatively inexpensive properties is if you end up buying the right property, and if you end up buying a property that does do well, that does increase in value, then that absolute equity gain is going to be really large. So let's say you bought one property worth $1 million in Sydney, let's say in 2014. A 5% growth on $1 million property is much, much more than a 5% growth on a $500,000 property. So I know so many investors, these are more high net worth individuals, that just buy really expensive property because even if they just get it half right and it only increases by 3%, 4%, 5%, that is still, like 3% of $1 million is $30,000. 5% is $50,000. The percentage doesn't seem high, but the actual quantum, the actual absolute amount is huge. So imagine if you said, I'd be happy with a portfolio that just increases 3% per annum. Normally people would say that's not such a good result, but if your properties are $1 million each, then 3% is all you need, okay? So that's another advantage of high-priced property, of maximizing your borrowing capacity and just splurging it on one property. If you do it right, you're gonna do really well. However, there is a litany of downsides, of cons, of buying one property as opposed to splitting up your equity, splitting up your borrowing capacity and buying two or three less expensive properties. Now, one of the pros of splitting up and buying less expensive properties is clearly diversification. So yes, you can do really well if you splurge $1 million in Sydney, but in that you can buy 2.5, maybe 3 properties elsewhere around the country. And if you end up getting that Sydney property wrong, then that's your entire funds, your borrowing capacity gone. Whereas if you split that that borrowing capacity and those funds up, you have more of an opportunity to make a mistake but still do well. All right, diversification. Hobart might not do well, but Adelaide has done well. Brisbane might not do well, but regional Victoria has done well. You have more chance for reducing your risk. The other upside of splitting up and buying cheaper properties is that yields are generally higher. yields are higher on less expensive properties as opposed to more expensive properties. Now, that's not a blanket rule, doesn't always exist, but as a generalization, and look, always with generalizations, there's exceptions, hence the name generalization. But as a generalization, a $400,000 property or a $500,000 property will have a higher yield, maybe 4.5%, 5%, 6%, maybe up 7%, versus a $1 million property. And really, that's just because there's not that many renters that can afford to rent really, really expensive properties. Of course, there's always going to be people that want to rent, really expensive properties, but the number of those people is less. Hence, the yields end up being pressurized, end up being compressed is the technical word, as you get more and more expensive properties. So if your yield is higher in lower properties, then your net cash flow is going to be better if you don't end up buying $1 million property, but rather buy two $500,000 properties, or split that $1 million into three properties. Okay, so your cash flow is better if you split it up. And because your cash flow is better when you split it up, your borrowing capacity is improved. So in many instances where a bank will loan you $1 million for one property, they will loan you $350,000 to $400,000 for three properties. Now, 400 times 3 is more than $1 million. So you see how when you've split up your purchases, not only are you getting better cash flow because they're higher yielding, but the bank is recognizing that and is then rewarding you with higher borrowing capacity. So when it comes to developing your long-term strategy, of course, the best thing is to have as many dollar value of assets in your portfolio as possible, right? Because you want to control as much value, as many assets from a dollar value as possible, right? So from that perspective, because the bank is rewarding you for cheaper properties, sometimes it's a better idea to split up and not buy $1 million property, but rather 2 or 3 less expensive properties. The other upside of buying less expensive properties as well is, we talked about diversification, but in the long term, in 10 or 15 years time, buying less expensive properties will allow you to buy more properties. The more properties that you have, the better flexibility you have in 10 or 15 years time to decide which ones you should sell. The traditional orthodox strategy is to, let's say, buy 6 properties in 10 or 15 years, sell 3, use the profit after capital gains tax discount from the 3 that you sell to pay off the debt of the 3 that you hold, and bada bing, bada boom, you have 3 properties completely unencumbered by debt, giving you close to 6-figure, if not 6-figure passive income. Excuse me. So when you only buy $1 million properties, it's not like you can buy 6 properties. So you might only be able to buy 1 or 2 properties. And so therefore it's harder for you to sell half your portfolio, because if you do so, you'll only be left with 1 property. And what if that's not a good one? Okay, so less expensive properties gives you more flexibility, more options down the line to figure out which are the higher yielding ones that I'm going to keep, and those are going to be my cash cows for retirement, versus which are the higher growth ones that have done me well. And now I can sell them, use the proceeds, the cash, the profit to pay off the higher yielding ones and have a life completely unencumbered by debt. Okay, and just on a side note, that is a strategy that works really well. It always has for dozens of years in Australia. It always will do. And that means that you're not having to contribute your hard-earned earnings, your savings from your job or your business into paying off your mortgage, right? You stay interest only and let the market pay off your mortgage by the growth of the 3 that you'll sell. So that's another upside of splitting up and buying cheaper properties than more expensive properties. So, I talked about one or 2 advantages of more expensive properties. We talked about 3 advantages of cheaper properties. Just while it's on my mind as well, one thing that you need to be careful of is avoid buying properties less than $200,000. That doesn't mean that they don't grow in value. It's just the transaction costs are going to be really expensive because there's a fixed element of transaction costs, legal fees, depreciation schedule, etc. And you have to pay that regardless if your property is $1 million or $100,000. So if you think that you should split up your $1 million of borrowing capacity in 10 properties, it's a bit of an extreme example, but in 10 properties worth $100,000 each, from a transaction cost perspective, that's a really inefficient way to develop a portfolio. You're spending so much money on transaction costs. It's really not achieving economies of scale. In fact, it's diseconomies of scale. It's an inefficient way to go about investing. So, personally, I favor buying properties between the sort of 250 to 300 mark all the way to 650, 700. That really is the sweet spot between getting all the advantages of the cheaper properties, borrowing capacity, yield, etc. And also getting or avoiding the disadvantages of just buying one large or more expensive property. That's kind of the sweet spot, and you can really easily find high growth suburbs and positive cash flow territory in that bracket. So hopefully that was useful. Guys, if it was, then just give me a like or a love or a comment below, or just ask me a question. Either DM me, I'll put a link up the top or down the bottom as well. You can follow that to learn more. Otherwise, just DM me. I'm happy to help you out. Or just ask any questions in the comments so other people can see and benefit from them as well. I'm PK, and have a great day. Catch ya. Bye.